Is the Walt Disney Company a buy in 2019? That is the question that I'm going to be answering in this video. Today, I'm going to be bringing you an example of how you can go through and use my stock analysis process, which is essentially the process that was founded in the principles that Warren Buffett teaches in his letters to the shareholders and that he's used successfully over his life. So that's what we're going to get into in today's video. We're going to start by looking at the business itself. Then we'll jump in and have a look and see if Disney has any kind of intrinsic competitive advantages. We'll have a look at Disney's management, and then towards the end we will do some intrinsic valuations in order to work out and see what a potential buy price for this company could be. With all that being said, this is not a recommendation or advice about Disney stock specifically. This is just an example of how you can apply the process that I teach on my channel. This is not to be taken as any kind of professional financial advice. If you want particular advice on particular businesses, then please see a financial advisor. But you can use this video to learn the process that I go through so that you can apply it to businesses that you're passionate about and that you're looking to invest in. If you do enjoy the video, please hit the like button or hit subscribe, do something. Comment down below, share it with a friend. Any of those things help out a ton. And of course, if you want to see some of my other videos, go check them out. There's about 40 hours of content on my channel. But with that said, let's get straight into the video. And let's start by looking at Disney's business and explaining some of the different components of the Walt Disney Company. So many of you would know of Disney as where it came from originally. So it was founded in 1923, and it was originally a very family-oriented film studio. But since then, Disney is a kind of different company. While that is still a major part of their business, they've also been acquiring and adding different components, different film studios, different TV networks, in order to make them really just a giant entertainment conglomerate, a diversified grouping of different types of entertainment businesses. And really, in 2018, their segments were broken down into four major components. So we had media networks, we had studio entertainment, there was parks and resorts, and then finally consumer products. And these are the four components of Disney's business in 2018. And the reason why I say in 2018 is because starting in this year, 2019, those are no longer the four segments. So the new four segments are media networks is still there. We still have studio entertainment, but now instead of having a parks and resorts and then a consumer products, those consumer products and parks and resorts are combined into one segment, which is now called parks and experiences and consumer products. And then the new fourth segment is direct to consumer. And there's a good reason why they've added this. And it's because they are now coming out and showing their dominance in the direct to consumer space, which is really what Netflix provides. If you don't understand what direct to consumer means, it just means exactly what it sounds like. They're directly delivering Disney content or Walt Disney Company content to customers, and they're doing this in a number of different ways. They have really four major direct-to-consumer products or services now available or going to be available in the next couple of years. And those four products are Disney Plus, which is expected to launch later this year, ESPN Plus, which is already out, Hulu, which the Walt Disney Company now owns 60% of, and Hotstar, which is one that a lot of you wouldn't have heard of Hotstar before, and the reason for that is because it's based in India, and it is the largest direct-to-consumer video streaming service in India, which is really quite fascinating. But if we just step back from the direct-to-consumer section for just a bit and have a look at how Disney performed in 2018 in terms of their previous four segments, we can see that media networks was by far the largest segment, taking up 41% of their total revenue. In second place, there was parks and resorts, which is essentially them selling tickets to their parks, people spending money on food and consumer products and products at the park, and also resorts. The third component is studio entertainment, which is where all of their films and live stage plays come out of. That's where the box office revenue is going to be generated. And the final small slice of 7.8% is their consumer products. And this is essentially where they're licensing out the brand name of Disney characters and the Disney brand to video game developers and manufacturers who want to sell products and services with the Disney brand on them. And the amazing thing about Disney is that it is such a massive business, generating a huge amount of revenue already, but really they've just consolidated their 4 segments down into 3, and they're bringing in yet another business, which is a huge opportunity. The direct-to-consumer market is not something small that they're adding to their business. This is a huge opportunity. If we look at some data out of IHN Kagan, we can see that in 2010, there was just 30 million global paying video subscribers for online services. Then in 2015, that jumped all the way up to 190 million. And in 2020, it is expected to be 810 million paid video subscribers. I mean, that is absolutely staggering. That is in just 1 year's time. And you can imagine if you had 810 million paying subscribers paying $10 per month, which is pretty low. The average could probably be significantly higher. That's $8 billion in revenue globally per month, which works out to be about $100 billion market for a global market. And that's a huge market that Disney can go into and take quite a big piece out of because they already have that established brand that they're bringing. And of course, all of their previous content that they've been developing over the past 100 years is going to be able to be filtered into those services. And they're already going to have such a massive head start over many of the other companies. The next part of our analysis is to look at economic moat, and this is where we're trying to look at the business and see if there's any kind of long-term competitive advantages that this company has over the other businesses in its industry. And we do this in 2 ways. We start by qualitatively looking at the business, trying to see if we can identify any kind of characteristics, and then we need to do a quantitative analysis where we try and see if it's backed up in the numbers. And don't be scared away by the words qualitatively and quantitatively. They're just big words, and it's not very difficult to do both of these. So let's start by doing a qualitative analysis. And immediately, the first quality of Disney's business that you would notice as an advantage is their recognized branding and their reputation that comes along with that branding. The Walt Disney has essentially just become this massively diversified business that has all of these different little segments that are all, or many of which, are very, very successful film studios or networks. You can think of some such as ESPN, the ABC network. Then you've got film studios such as 20th Century Fox, which they just recently acquired. And they've been doing this along the way their entire lifespan. And they've been acquiring these little businesses, or not even little businesses sometimes, like 20th Century Fox was a huge acquisition. But they're acquiring these businesses and adding businesses that have provided really successful films for consumers. And if you look at any of the top 10, top 20, top 30 grossing, most revenue generating movies or stage plays, you will notice that either Disney or Lucasfilms or 20th Century Fox, one of these studios would have made some of those movies, a significant amount of those movies. There's even more. Pixar, there's many that you could think of. Marvel. There's so many different components of this business that are loved by consumers and have that brand reputability around them. But as I said, us having that opinion about Disney is not enough. We need to see that that economic moat, that advantage, is backed up in the numbers. And we do this by looking at 4 fundamental areas. We look at revenue or sales, we look at earnings per share, we look at equity, and we look at free cash flow. As you can see, sales growth has been fairly slow, but it's been very consistent at around 5 to 6%, which is a good sign to see that consistency and increasing over time. Earnings per share has grown massively over the past 9 years at a rate of around 20%, 19-20%. Equity, again, has been slow, similar rate to sales, but again, has been fairly consistent and in the last year has grown at about 17%. And free cash flow is a similar story to earnings, growing at 12.85% over the past 9 years and very, very consistent over all of those periods. And essentially, when we combine our story, our opinion, our hypothesis about a company's moat with the fundamentals that show us that they do have a moat, we can then conclude that they do have some kind of intrinsic advantage. And we can be confident that this company is still going to be around and thriving over the next 10 years. And then from there, of course, it's just a matter of working out how successful they're going to be. But at the bare minimum, we know they're going to be around and they're likely, at the very least, going to be as big as they are today in 10 years' time. By the way, guys, if you're interested in learning more about this 4-step process that focuses on the 4 key Warren Buffett, Phil Town, I guess, investing principles that are essentially circle of competence, making sure we're investing within businesses we understand, economic moat analysis, as we just did, looking at management in a number of different ways, and then doing intrinsic valuation. If you're interested in learning more about that 4-step process, then I actually put together a free 20-minute video on my website. It's a training video, and you can watch it and you can learn the process that I go through and the 2 major questions that I ask every time I'm making an investment, as well as some other things such as some beginner mistakes. Then go check that out if you're interested. And if you're a complete beginner here, that video might be a little bit too advanced for you. So if you're a complete beginner, meaning you haven't invested in the stock market and you're interested in learning more about this stuff, then I suggest you just check out some of the other free content on my channel. But moving on, let's talk about management. And we can't really talk about every area of management in this short video. I talk about all of the areas to the members of my platform when I do my full analysis, because those are 60-minute presentations. However, in this video, I'm just going to focus on one area because it's really difficult for me to go through all of them in detail and provide you some value. So we're going to zoom in on one of the areas, which is capital investment. How effective are they at investing within the business? And the key metrics that we look for here is the return on invested capital. This is comparing the amount of owners' earnings, the amount of cash that is returned to us, to how much they're investing within the business. And are they able to compound their cash flows within the business? The return on invested capital for Disney has been very strong and consistent over time, as well as growing each and every year. There's only 2 years in the past 10 years that had an ROIC of less than 10%. And of course, you can see a very strong upwards trend, which indicates that they are getting more effective at their investments within the business. And not only is their ROIC very strong, but the cash that they're generating on their investments, they are taking it and reinvesting a significant amount. And that's an excellent sign. It means that if they can maintain a high ROIC while also reinvesting all of those profits, they're going to be compounding those cash flows within the business. And as a result, compounding the growth of the business and its stock price, which is exactly what we want to see. It's one thing for a company to have a high ROIC, but it's another thing for that company to be able to reinvest all of their profit or a significant amount and still maintain a high ROIC. And that is something that the Walt Disney Company has been able to do consistently over the past 10 years. And that brings us, of course, to the final part of our analysis, which is to work out how much we're willing to pay for this company. And how we do that is simply by calculating how much cash we expect to get back from this company over the next 10 years. And generally what I do is I'll do a range of different models. I'll use different growth rates into the future, different amounts of cash that I estimate that a company can return to us. And that way I can get a range at which intrinsic value likely sits, and of course a range at which I'm willing to start investing. But in the interest of time, I'm not going to go through all of that. I'm just going to show you one model and basically use it as an example of one of the intrinsic valuation calculations that you could have come up with. And of course, I'm going to be using my free stock analysis spreadsheet to do this. So if you want a copy and you want to follow along and try mess around with different numbers in there for companies you're looking at, then you can get access to that via one of the links down in the description below. It's completely free. But let's jump over to my computer and do some intrinsic valuation. So earlier in the video, when we were looking at the 4 fundamental areas, we noticed that sales and equity were growing at between 5 and 6%. So for one of the models, I'm going to be using a growth rate of 5.5%. Our starting cash flow is going to be $12 billion because this is what I've calculated cash flow for owners to be. And how I calculated that was essentially taking operating cash flow for 2018 and subtracting maintenance capital expenditure. And that maintenance capex is an estimation using some calculations. If you want to learn more about that, then go to that training video in the description below and check it out. I talk about that with my members in the group in depth, and it's going to be way too complex for me to go through it in this short video. But essentially, using that starting cash flow and using a growth rate of 5.5%, that gives us an intrinsic valuation of $285 billion for the entire company. And then over on the left, you can see that in the required rate of return box, I've put in 10%. And then, therefore, you can see in the table, we're getting a buy price for the whole business of $180 billion and a buy price per share of $121. So what does that mean? It essentially means if you were able to pay, according to this model, just an example, remember, according to this model, if you were to pay $121 per share and the company was able to grow at 5.5% per year for the next 10 years or thereabouts, then you would expect to make about 10% per year on your investment. Now, for me personally, when I'm using this investment strategy, I'm usually targeting a rate of somewhere between 15% and 22%. So much higher than that 10% that I put in just then to show you what the current stock price is saying that the stock is offering. So I'm certainly in the Walt Disney Company would be looking, using this example, using those models, for the stock price to be substantially lower than the current stock price, because not only are we trying to make an above average return of maybe 10 to 15 to maybe even more percent, but we also want to bake into that price a margin of safety so that if we're wrong in our valuation, we're still going to make the return that we want. So for that reason, using this example and applying my analysis strategy to this stock and using that example model, then this would not be a buy at the current stock price, and it would mean that you would want to see this stock come down substantially. So I hope you guys enjoyed this video, and I hope this sort of provided some value so that you can go out there and apply this process to any businesses that you're looking into. Remember, this is not a recommendation about Disney itself. It's really just an example so that you can go out there and find the businesses that you're passionate about, that you love learning about, and you can apply this process to those businesses. So just a quick reminder, again, if you're interested in learning more about this process, first link in the description below to go to a free 20-minute training video. But if you did enjoy it, the best way you can show me is just by hitting the like button or hitting subscribe if you want to see more content. But for now, guys, I'll see you in the next video.